Let's move into our speaker, the main event for today. Mike Feidler is our speaker this morning. Mark Feidler. Mark joined the private equity firm MSouth as partner and co-founder in 2007. He's got a bachelor's degree in economics from Duke and a JD from Vanderbilt. Nevertheless, he's agreed to be with us here at Terry Third Thursday. Now, Mark started a very successful career in 1981 as an associate in the corporate law section of King Spalding. In '86, he joined Robinson-Humphrey and worked in its investment banking department. After 10 very successful years in various roles of executive-level operations positions, his career veered towards M&A and transactional experience. Mark joined BellSouth in 1991, and when BellSouth and AT&T merged their domestic wireless operations to form Cingular, he became the COO of Cingular Wireless. He's also served as president and COO of BellSouth Corporation until the merger with AT&T in December of 2006. Mark currently serves on the board of directors for New York Life, and he's served on the board of directors of Cingular as well. And this morning, Mark's topic is update on private equity in the Southeast. So please join me in welcoming Mark Feidler.
Thanks.
Thank you.
Well, it's great to be here, and we'll try to make this interactive because my guess is there are you may be pretty familiar with the topic already, but what I thought I'd do is walk you through briefly sort of private equity. And what's interesting is we now kind of accept it as a pretty commonplace activity in terms of corporate ownership and the way businesses are handled these days. But it was interesting as I started pulling things together for this. It's sort of interesting to note that it really is a phenomenon of the last 30 to 40 years in a big way, and was really non-existent prior to the turn of the 20th century. I mean, in essence, if you go all the way back to the Industrial Revolution, you had industrialists who ended up with more cash than they had opportunities, and so they needed to invest outside of their core businesses, and so you began to see merchant bankers and people like J.P. Morgan who went out and essentially bought companies. Over time, what you see is that in the 60s, this was sort of a backwater activity, but people started to see the opportunity here. They began to get their own capital and some third-party capital, and you began to see some of the organizations that we think of as private equity today beginning to emerge. But it was really the 80s when institutional capital came into this asset class in a big way. And you began to see pension funds and endowments. Interestingly, university endowments were one of the real driving forces behind private equity in terms of wanting to get access to this class of investments. And it was in the 80s actually when our predecessor firm here in Atlanta, Cravey, Green & Wallen, was founded in 1984. KKR was founded in 1982, Blackstone, all these other big firms that we all know today really got their start there in the 80s. And then what happened was you get out into the 90s and the early part of this century, the asset class really took off. I mean, a tremendous amount of money was raised behind private equity. The period leading up to the most recent financial crisis was a period of unprecedented levels of private equity investment, and I'll show you in a minute the numbers on that. And then, of course, what happened was, like everything else, in 2007, 2008, this business came to a crashing halt. In essence, particularly on the buyout side, you need access to credit markets. And more than anything else, what happened in that time frame was we had a liquidity crisis. We didn't have access to borrowing. And so the industry really came to a standstill in late 2008, 2009. And the Dean and I were talking earlier, what's interesting is it has recovered pretty dramatically. Somewhat inexplicably to me at times, but credit is very available again in our industry. It's been available again now for about 24 months, and you're seeing that now in the number of transactions that are taking place. And interestingly, the prices that people are willing to pay. So let's talk a minute about, some of this is probably repetitive for many of you, but, I think of private equity as privately held companies where the ownership is other than with a small, closely held group of individuals or the management. historically, that meant they were smaller companies, but interestingly, in the 90s, because of institutional capital being made available, you saw some very large transactions. Of course, the transformative transaction of private equity getting into larger companies was when KKR acquired RJ Nabisco back in the mid-90s, and resulted in barbarians at the gate, and it really was sort of a watershed moment for the industry. Different asset classes, different strategies within private equity. At MSouth, we're involved in leverage buyouts, control buyouts, but there are people who take non-control positions. They're providing growth equity. You've got the venture capital industry, where in essence it's more seed capital, generally non-control. There are people who focus on distressed situations, in some cases that they buy distressed, poorly managed companies with the intent of rehabilitating the management and the strategy of those companies. In other cases, they loan to own is what we call it. They buy distressed debt with the intent of using that position to ultimately gain control of the company. Real estate is another industry that has changed dramatically during my career, in the sense that institutional money in the real estate business, if you go back 30, 40 years ago, was primarily some pension funds and insurance companies making direct partnership investments with developers. Today, it is much more prevalent to see funds that have been raised both for investments in real estate development operations, and there's a huge base of capital now that's out there buying fully developed properties as an investment class. Oil and gas, natural resources is another area where, on the oil and gas side, much of the exploration these days is done by private equity-backed ventures. Once they get through that risky phase of the process, oftentimes those businesses are then flipped and sold to people who are anxious to have producing assets. And interestingly, Atlanta is, when you think of other natural resource asset classes, Atlanta is sort of the epicenter for timber-based private equity investments. There are a number of large timber private equity firms based here in town. What sets LBOs apart from conventional public capital structures is, as people understand, they tend to have a more leveraged balance sheet. So it's a more aggressive use of debt. Part of that is, as everybody understands, if you stretch the balance sheet, use more debt, you can enhance your equity returns. I mean, the downside of that process, obviously, is the fact that you have a much more vulnerable balance sheet, and you're less well able to withstand downturns in the business. So in our business these days, there's a wide range of capital structures that are used, but I would say the vast majority of deals these days are being done with equal amounts of debt and equity. So that makes them slightly more levered than most public companies. But there are people that are still doing transactions where 70, 80% of the capital comes from the debt markets. That wanes and waxes based on the receptivity of lenders, but that is the primary difference in terms of capital structures. And the reason why so many institutional investors want to be in this asset class is they understand that in their allocation of assets, they're looking for opportunities where they take a more aggressive stance in terms of balance sheets. Private equity, I threw this in. It's interesting in the presidential debate right now. It's unclear whether or not we're a scourge on the economy, or we're actually, something that helps, bring about enhanced returns in companies. As this industry has become much more institutionalized and much more mature, what you're seeing is that private equity now is more than just, you go back to the mid-'80s, it was mostly about buying underperforming companies with an aggressive capital structure and using free cash flow to pay down debt. I mean, that really was the strategy. Now you'll see that there are private equity firms that buy companies with the proposition of taking them into new markets, taking them into new products. It's much more varied set of strategies that private equities pursue. Well, the biggest change is the fact that private equity funds have become pretty commonplace. And so, like I said, prior to 1960, there really weren't private equity funds. They really came on the scene in the 80s and have become very prevalent now. They've gotten, in the early days, everybody was a generalist. People would buy, all different types of businesses. Today, like everything else, it's become such a big industry. There are very few generalist firms left. You generally have to have a particular focus if you're going to be in the private equity business. In the case of MSouth, we do lower middle market buyouts, meaning transaction sizes between, say, 25 million on the low side and 150 on the high side. We try to focus geographically, so we present the opportunity for our investors to have exposure to what we think is a relatively attractive part of the U.S. economy, but there are people who focus on emerging economies. Asia is very popular these days with institutional investors who are trying to get private equity exposure to that marketplace. And there's a whole host of strategies that people pursue. Some people, like I said, are focused on a single industry, be it distribution, logistics, those kinds of things. The thing that sets us apart, in addition to the capital structure, is the fact that these are highly illiquid investments. In essence, the limited partners, the people where the vast majority of this capital comes from, are making 10-plus year commitments. So once you sign your limited partnership document, you are on board for at least 10 years. And for many people, that's a daunting proposition. What's interesting is increasingly now there are a group of private equity firms that believe the 10-year typical life cycle of private equity is too short. Because if you think about it, what that means is in a typical private equity fund, you'll take 5 years finding uses for the money, putting the money to work, and then you'll spend 5 years trying to get liquid again. Because the idea is you got to take the money, put it to work, convert it to cash again, and return it to your investors all in that 10-year period. So on the one hand, like I say, that's highly illiquid relative to, say, owning public stocks, where on any given day you can decide to get out of an investment. But relative to many situations, buying a large enterprise and saying we're only going to own it for 5 years is a relatively short time frame. And so there are actually now a group of private equity firms that have come on the scene that have 20-year time horizons, which is pretty interesting that there are investors out there who have an appetite to say, I'm going to give you a substantial amount of money, and I don't really expect to see any of it back for 20 years. I mean, obviously, you've got to have a very long investment horizon if you're going to do that. And there are people that have sufficient assets that this is a very modest allocation, obviously, of their overall investment portfolio. The typical private equity model is one of alignment of interest between the general partners who make the investment decisions on behalf of private equity funds and their limited partners. The idea is that, at least initially the idea was, and as these firms have gotten bigger, you can debate whether or not this is still the model, but the idea was that you're able to draw fees on the committed capital so that you can run your operation, so you can have employees, office space, go out and fund your transactional activities. And then over time, as you sell investments and presumably reap profits, you pay back all those fees that you've called from your investors. So they have sort of the first priority on the return of funds. And then once you get to the point where there are profits, the idea is that the general partner participates generally in 20% of the upside. So that has been the model historically. And for companies that operate in the range where we do, it tends to work out that your management fees roughly equate to the operating costs of your fund. And so people are not getting rich based on their management fees. The idea is that as if and when you produce profits for your investors, you'll share in those profits. What's happened is when you get to funds that are raising tens of billions of dollars, this audience, I'm sure, is pretty good at math. You take 2% of tens of billions of dollars, and suddenly you're raising hundreds of millions of dollars to just run the fund. And people have started to realize that this alignment of interest is no longer as pure as it used to be. If you're at these bigger funds, I mean, you can get very wealthy, never making a profit for your investors. And some of that is starting to play out now in the larger funds. And as a result, and I'll talk about this in a minute, there is a heightened scrutiny now on the fee structure because people are just saying, you don't need that kind of money if you're making, multi-billion-dollar commitments. In terms of the process, it's not unlike anybody else who's out looking for investments. I mean, one thing is you've got to look for opportunities where you think, I can get in, I can actually improve the business, and I can get out, all in an average of 4 to 6 years. So that says that, some businesses that have a long-term transformational strategy, those kinds of things are probably not going to be particularly suitable for this business. But in essence, it's the deal sourcing can be different in terms of the market has become much more efficient in that there are many more transactional intermediaries these days than there used to be. Back when I was at Robinson-Humphrey doing M&A work, if you had a company that was less than a couple $1 million a year in profits, chances are you didn't know an investment banker, you weren't being advised what your options were all that effectively. And there were people out there that would find you and might work a transaction with you. Today, there are business brokers, there are investment bankers. It is a much more efficient process, and it is the rare situation anymore where you can get involved in a transaction, even down in the size range I was just talking about, where there's not some third party involved. So the role of intermediaries has become much more important. The due diligence process is, the same as any other acquisition where you're looking to buy something. You need to essentially assess, the business opportunities, the people, the legal exposures, the financial exposures. In terms of execution, the one thing that's a little different about private equity is because they're more highly levered, there's a much greater emphasis on being able to arrange financing and understanding how that financing's put together and how you structure that. And then, it's like anything else. It's portfolio management. Different firms have different capabilities in this regard. Some firms have a stable of veteran managers who they're prepared to introduce into situations and essentially make aggressive changes in who the management is at companies. Others, it's more about underwriting people on the front end. In the case of MSouth, our whole strategy is that in lower middle market companies, it is very risky to be changing out management. And so we are as interested in making sure we're backing the right people as we are making a decision about backing the right line of business. We think that, in these smaller companies, the CEO, that man or woman is a lot more than just the CEO. Oftentimes, they're also the person that's got all the customer relationships, or they're the ones who actually know how the factory runs effectively. And when you go out to change that person, it can be a tough thing. And the other nice thing about the private equity business is you get to decide when you sell within reason. And a lot of money is made about in and around that decision. You get to make that decision in terms of where the company is and its progress and its momentum. We all know that companies that are performing well and appear to have, a pretty attractive immediate future bring a bigger price than things that are, not performing well. And then lastly, you get to decide, believe it or not, the relative valuations that are assigned in the marketplace when you go to sell also vary probably 20 to 40%, over a span of a couple of years, which is kind of amazing that, in 1 year a company's worth $100 million, and with the same level of profitability 2 years later, it might be worth $140 million just based on the fact that credit's relatively more available, people are feeling better about things, there are relatively more buyers in the marketplace than had been the case. And so one of the great advantages of being in the private equity business is you get to pick both the time and price at which you enter and the time and price at which you exit. In terms of company characteristics, these are things that, would be true no matter what type of buyer of a business is involved. Although you need to be cognizant of the fact, if you're going to be in the leveraged buyout business, that there are certain aspects about a business that do not lay down well with a highly aggressive capital structure. So if you're going to have a highly levered balance sheet and commitments to banks with covenants, you need to make sure that the type of business you're in is one where you have a reasonably predictable set of outcomes. And so where people get in trouble is if you get involved in a highly cyclical business, one with a lot of operating leverage, and you hit a downturn and you're not able to shrink your balance sheet and your working capital commensurate with what's going on in the marketplace, you can really get in a lot of trouble. But for the most part, like everybody else, people are looking for good businesses with good management teams that are well positioned in their marketplace, have good growth opportunities. What's interesting is on the right there, what you see is that where people made money in the leveraged buyout business has really evolved over time. What you see there on the far left is that in the 1980s, this was a business where you could be very aggressive with the balance sheet. You could put lots of relative debt on a situation relative to the amount of equity that you put in a transaction. And as a result, what people were looking for back in those days, if you remember back, there were a lot of larger companies and mid-sized companies that had not been aggressively managed. You know, the United States was sort of in a period where people had not been willing to make some of the tough calls about business. And so this was sort of the same area of corporate raiders where people were coming into public companies and putting a lot of pressure on increased management. And really the blue at the top there is, if you look at the total profits that were made during that era in terms of owning and selling companies, what you see is the vast majority of the business there came from the fact that they were highly levered. People were essentially balance sheet engineers. They put a lot of debt on businesses. They were able to do that with reasonably favorable terms. You get the tax shield from the deductibility of interest expense, and so the fact that, you know, they had more debt on their balance sheets than comparable companies. At the end of the day, it was all about sort of financial engineering. So that was the era of financial engineering. What you got in the 80s was, for the first time, people saw multiple expansions. So people were buying a company for, say, 6 times its EBITDA, and they woke up 5 years later and realized that the same category of companies were now selling for 7 or 8 times EBITDA. And so if you've got, you know, 4 times leverage on a business, and you get an expansion from 6 to 8 times, even if the profits are unchanged and you were shrewd enough to sell during that window, you doubled the value of your equity. And so that was the era where multiple expansion really began to show up. What happened then is, you know, the market gets more and more efficient. There's more and more money raised. You get out into the early part of this century, and the real emphasis has become on operational improvements. And so you see private equity firms hiring many more former executives. They're building their own sort of consulting and management practices to oversee their portfolio companies. And so the day of financial engineering, as you see up there in the light blue, really began to recede because the market, there was enough capital raised that those are not, you know, there's nothing proprietary about putting more debt on a company. Enough people figured that out, that sort of washed through the system. And we entered an era where you really needed to be able to bring more value to the table than just that. And if you look at the current environment we're in, it really is all about now being able to get involved with companies, sit down with that management team and understand, you know, sort of what are the latent opportunities that exist in your business. Is it, you know, better operational execution? Is it geographic expansion? Is it product expansion? Is it, you know, fleshing out the management team in such a way that, you know, you've got better institutional capability? And so we've now entered a period where it's not very much at all anymore about financial engineering. It really is more about running better companies. And the fact that an alignment of economic interest with knowledgeable owners who are very much involved in the day-to-day strategy decisions, execution decisions, that, you know, there's a thought, and I'll show you here in a second, that it can produce better results than some other forms of ownership. The way we measure success or failure in the private equity industry is there are 2 kind of gross measures out there. One is a multiple of invested capital. And so that measure is just, for every dollar I put in, how many dollars did I get back, sort of irrespective of how long it was in there. And it's interesting, you're all finance people, and so, you know, I'm sure you realize that if you wait long enough, you'll make a profit on just about anything. Although that's being tested in the current environment. But even your house, I feel confident. If you wait long enough, the value will recover. And interestingly, I would say about half of our institutional investors, that's the measure they look at. They want to know, like, if I give you $1, how many dollars did I get back? So that's multiple invested capital. Internal rate of return is important to the other half of the investors. They're basically 2 ways of calculating the same thing. The difference is that, you know, internal rate of return obviously captures the time value of money. And so what you'll see is that people who are IRR driven tend to favor firms that are still pretty aggressive about capital structure. So as soon as they get some nice increased profits in a business, they're refinancing that business, paying big dividends out, so that you're getting most of your invested capital back. So you've got a smaller piece of equity remaining in the deal that then is the basis that you're measuring your IRR off of going forward. In our industry, what investors want to hear is that you're targeting 2.5 to 3 times multiple invested capital. which translates into, with a normal hold of 4 to 5 years, an IRR of 20 to 25%. That's pretty aggressive. There were periods of time when the industry was actually able to produce those kinds of numbers. What you see at the bottom is private equity still has outperformed many of the other public asset classes of equity investment. But at 13% in this particular study over the last 10 years, that's a far cry from 20 to 25%. Now, the fact of the matter is people are pretty pleased these days with a 13% return. But it's not, if an entire industry is out there trying to produce 20 to 25% and they're coming back with 13, I would submit to you that either they're not telling the truth or they're not very good at what they do. But nonetheless, I find it amazing, having been in the industry now for 6 years, that when you go out to fundraise, those are the numbers people want to hear, which just seems to me kind of crazy that we've not yet sort of owned up to the fact that those kinds of returns are just not going to be achieved in the current environment. What's interesting is, again, you need to be very careful that, like anything else, there is wide disparity in those numbers. Those are averages across the entirety of private equity. What really goes on is top quartile firms, and there you need to look over more than one fund. There are people out there that historically have produced returns north of 20%, which obviously is a pretty attractive return. But at the same time, there are lots of folks who, in essence, return far less than $1 for every dollar invested. There's wide disparity, and so from the investor side of this equation, all the competition is about trying to get access to the people who have those better track records. And it's become an enormously big industry in terms of calling on investors and competing for their dollars. But it really is, the focus is the big guys. They have the leverage and the access to get to the better funds. And although that's changing actually, because what happens in the fund businesses, people have success, so they raise a bigger fund. They have success again, and they raise a bigger fund. And what people fail to realize is that managing a $400 million fund is a very different business than managing a $3 billion fund. Typical private equity fund will try to do about 10 investments per fund, so you get some portfolio diversity. So if you've got a $400 million fund, you're writing 10 $400 million checks. If you have a $3 billion fund, what happens is they end up doing about 5 or 6 deals in a fund, and they end up being $500 million equity checks. And I would submit to you that's a very different business, buying what otherwise had been public companies we've all heard of, versus trying to find the neglected family-owned business that there's real opportunities to help somebody drive some growth. I threw this slide in. This is actually out of a deck we use with some of our investors. The South is sort of a backwater wasteland when it comes to private equity. We've got one of the most attractive economic environments in the country. We've outperformed the rest of the country in terms of growth and jobs and economic expansion over the last couple decades. And with all that, we've got about a third of the economic activity of the United States, and yet we have less than 10%, or right around 10% of the private equity dollars are domiciled in the South and focused on the South. Now, there are plenty of firms in New York and Cleveland and Boston and Chicago that will do transactions in the South, but their offices are not here. And even of that 10%, most of that is in the oil and gas business, and it's in Texas. About 7 of that 10%. So it's one of the reasons that we've been able to be successful and raise money is the fact that we try to provide unique access to a lot of our investors to the ability to invest in the Southeast. The other issue that this raises is the private equity business, for the most part, is very much an apprentice business. If you look at private equity funds that are new to the business in the last 10 or 15 years, almost without exception, they've been started by people who left some other private equity firm, successful private equity firm. And so what happens is if you don't have that critical mass of activity, it's very difficult to have these little groups that leave and start, a different strategy or a different focus. And so, in Atlanta, by far and away, the biggest private equity firm is Rourke. And it came about because Neil Aronson had been in the business in New York, moved down here to Atlanta because this is where he wanted to live. And he's been very successful. He's got in excess of $3 billion now of private equity that he's raised. You had our Capita, which was based here in Atlanta. You've got Navigation, which is a relatively small firm, and then you got MSouth. And so on the buyout side, it is relative to the size of Atlanta and relative to the size of the Southeast. It's a real opportunity, but it's unclear exactly how we get a bigger base of activity here. So in terms of recent trends, which is probably more interesting to most of you, I should have rolled this back further because what you'd see is that throughout the last decade was really the go-go days of private equity. I mean, it just tremendous amount of money came into the industry chasing these above average returns. And what you see here is that private equity was no different than any other business in the sense that in 2008, we're seeing very busy activity, although it was down from 2009. And then, 2007. And when we get to 2009, like everything else, the business just essentially stopped. And what you see since then is it's had a pretty decent recovery, which is, a little interesting in that what happened in 2009 and into 10 was that there just was no credit available. If you were doing private equity transactions, you were working hard to try to figure out where the debt was going to come from, or you were doing transactions without debt. And so there were people that basically said, we'll buy the businesses now, we will wait a year or two, and we'll put leverage on it a year or two down the road. We'll change the balance sheet later. But I'll tell you now that debt is, very available again. Commercial banks in the last 24 months have come back into the marketplace reasonably aggressively. In our marketplace, in the lower middle market, it is fairly easy now to arrange 3.5 to 4.5 turns of debt on a transaction, which is, a gracious plenty for the capital structures that people are looking to do. So debt is no longer a limiting factor here. Part of what you see here is this is the number of dollars that were raised in each of these years for investments in private equity. And so what you'll see is that we're sort of rocking along here, and we get to the 2001, 2004 time frame, and all of a sudden this just goes crazy. And so what happened really was there was an entry of a reasonable number of new firms, but the likes of KKR, Carlyle, Blackstone, the big names all just started raising these mega funds. I mean, just, $10 billion funds, $15 billion funds. And so that's what happened in that time frame. It's just a huge amount of money just came rushing in. And of course, that died off when we got the financial crisis. What's interesting about our business, and maybe unfortunate, is the fact that once that money's committed, it's committed for 10 years. So at the very end of this economic cycle where people thought, every tree was going to grow to the heavens and there was no limit to anything, a huge amount of money got raised. And if you'll recall, some of those commitments, it's unclear how they were going to get funded. I mean, Harvard's endowment was a big player in this, and they got caught in a tremendous liquidity squeeze. A number of other university endowments who had been very aggressive about making private equity commitments got themselves sort of in a bind in terms of being able to honor these commitments as other sources of liquidity and other assets on their balance sheet took a real hit. So what that means is, as you look at it today, the uninvested amount of money that is out there, so these are dollars that have been committed, they're in the hands of GPs now. These are blind pools, so once you get a commitment from your LPs, their ability to say no thank you is gone. They don't get to approve your decisions deal by deal. They don't get to comment on whether or not, they do, but legally they can't say, I'm out of this deal, or I don't think now's the time. Once they've made a commitment, it is up to the general partners to decide whether or not the commitments are going to be made. And so what you see there is that currently we've got $425 billion, so $500 billion of uncommitted private equity dollars. But what's really disturbing about that fact is that, as I said at the outset, you're supposed to invest this money in the first 5 years. As a matter of fact, these partnership agreements have an investment period that runs for 5 years. Once you get out beyond that 5 years, you can, depending upon the terms of your deal, you can extend it 1 or 2 years. Sometimes you have to get the agreement of the limited partner, sometimes you don't. But in all events, you need to put it to work within 7 years or you send it back. And, you know, I hate to be this cynical, but people in our business, they're not much on sending money back. You know, they get 20% of the profits. It's sort of like if somebody sends you to Vegas and says, you know, you can keep 20% of the winnings, my guess is you're going to put all the money on something before you come home because, you know, why not? And so that's what's going on right now. You've got, of that money, that $500 billion, it is either in its final year or the final 2 years of its investment cycle. So what we're seeing in the marketplace is people are just, they want to spend money. And so notwithstanding the fact that the economy is a little uncertain right now, you know, whether it's domestically, globally, you know, it's tough to get overly excited about the business opportunities in a macro sense. We're seeing multiples that are very high by historical norms. And the reason for that is you've got a lot of buyers chasing a finite number of opportunities. And so I think, you know, what's going to happen is you get these are long feedback loops. You know, nobody will know how good the deals were in 2012 until we get at least to 2017, and probably, quite honestly, because people hang on to their losers longer than they hang on to their winners, you know, it'll be 2019, 2020 before we really know how wise it was to put money to work in this time frame. But, you know, it is interesting that there's just a tremendous amount of capital out there chasing deals right now. I better go ahead and, you know, in terms of current issues, I talked on the lending environment. There's plenty of senior debt right now. There's been a tremendous amount of mezzanine debt that's been raised. Mezzanine is the layer of debt that sits between senior and equity. They're looking for, you know, enhanced returns. That's so competitive right now. That was a business where in the old days people were, you know, targeting 14+% returns on mezzanine debt. Generally had warrants associated with it where they wanted a piece of the equity of the deal for free. That's become sort of a 11, 12% no warrant market these days. There's just been so much money raised. But it makes sense, right? I mean, if you can't get return anywhere else, you know, 11, 12% looks pretty good these days if you're with a mezzanine fund that has been able to produce those kinds of returns over time. As I said, transaction multiples are at what I think are abnormally high levels right now, given some of the uncertainty that exists out there. Fundraising, it's amazing. There are 1,800 private equity firms that are in the market right now trying to raise capital. So it's a very crowded marketplace out there. You know, I was trying to do the math the other day. The number of public and private pension funds and endowments that really have the capability to make a meaningful commitment to private equity is, you know, probably less than 300 or 400. So every one of these 1,800 people is trying to get a meeting with those folks. And so it's sort of a crazy carnival-like environment out there. As a result, there's a lot of pressure right now by better investors on terms of private equity deals. The limited partner community formed an organization about 5 years ago called the International Limited Partnership Association, ILPA, and they came out with model guidelines for what the terms of transactions ought to be. And not surprisingly, they have cut way back on ancillary fees, which, you know, I think is to some degree long overdue, but don't quote me on that outside of this room. You know, hurdle rates are being negotiated, terms in general. You're seeing increased concentration amongst LPs themselves. Many LPs go through advisors, asset advisors, and a couple people in particular have really gotten aggressive about bringing assets together. And so this, you know, like any other marketplace, there's consolidation. Those people now have relatively much greater influence over what's going on in the marketplace, and it's making it more difficult in terms of fundraising and the terms that can be negotiated. There was a phenomenon in our industry called fund-to-funds, where smaller investors who wanted access to this asset class would invest in a fund whose sole purpose then was to aggregate that money and invest in larger funds. I'm sure everybody's read a lot about the fact that in a much lower return environment, you know, to pay 2% to somebody as fees up front and a percentage of the profits, that gets tough to figure out how you're going to earn returns. If you introduce a fund of funds in the middle, they took 1% fees on top of the 2% fees. They took 10% of the profits in addition to the 20% of the profits. So you start adding all that together, the fund of funds vehicles are really under pressure right now. They're sort of, they're not disappearing, but there are a lot fewer of them than there used to be. And in our business, there's an 8% hurdle. You get 20% of the profits, but only after you've returned 8% compounded to your investors over a number of years. And so in the current environment, 8% is a pretty steep mountain, you might think. And so some people are now revisiting that. A lot of hedge funds actually are in the market now, sort of coming back with different economic propositions for people in terms of profit sharing. Institutional co-invest is a very big issue now. A lot of the larger funds have said, we want the opportunity for every dollar you invest in a transaction, we want to be able to invest a dollar outside of the fund in the same deal. And the idea there is they get to do that without paying fees, they get to do that without the 20% profit share, so it's a much more cost-effective way for them to dollar average down, and that's a much more common request from large influential investors that they have those co-invest rights. Tax policy changes, these run across the board. I mean, obviously, if for some reason interest deductibility were to change, that would be a real issue for the private equity industry. I mean, part of the enhanced returns comes from the fact that there is this tax arbitrage and the deductibility of interest. There's been a lot in the news the last 4 years about the fact that carried interest, that 20% profit that I was talking about, is taxed at capital gains. That is, that's going to change. I mean, that's not going to last. I mean, I came from the corporate world, and when I joined this private equity firm, and for the first time, I said, that can't be right. Who are you guys using for tax counsel? And sure enough, it's been that way obviously it's been that way since Romney was in the business. So, that is not going to last, I don't think. There's increased regulation of our business. This used to be a wonderful business where you'd buy an asset, you didn't revisit what it was worth until you sold it. And so you just basically told people, look, it doesn't matter what it's worth in between because, you'll get your money back when we sell it, and why are we going to waste a bunch of time trying to figure out what things are worth? Well, the accounting rules have changed where we now have to mark to market every quarter our investment portfolio. But more importantly, we all have had to become, even smaller firms now, registered investment advisors. So, very substantial compliance costs. I mean, it's like in our case, we have roughly 25 investors. These are all, multi-billion-dollar pension funds, endowments, very sophisticated people. They come to our office anytime they want. They can ask us anything they want. We'll do anything they ask. And yet, we are now regulated on the basis that, we're sort of dealing with nothing but, lower net worth, unsophisticated investors. It's sort of a crazy outcome. I talked about the uncertain business environment. I guess I'll close with saying that, it just seems to me when you look at the amount of money that's been raised, you look at the overhang in the market that, private equity has become so big now that there are three things that I think are inescapable. Death, taxes, and ultimately reversion to the mean. And so, I think because of the lack of liquidity, that private equity probably, properly done, should produce, maybe 100 to 300 basis points of return above, publicly traded equities. But the notion that over long periods of time that we're going to be producing 20, 25% internal rates of return in the current environment, I think is a little Pollyannish. So, I think that is an issue that our industry is yet to go through, which is the fact that, you're seeing it already. Some of these mega funds that raise tens of billions of dollars, their current returns are well down in single digits. And, that's an issue for them. I mean, they're a lot of people are scratching their heads saying, why are we paying all these fees and share of profits and everything else to get a return that is in line with, or in some cases, not as attractive as we get with public equities. So I think there's a shakeout coming in our business. So with that, Dean, should I throw it open to questions? Or have we run out of time, perhaps?
Yeah, we've got time for for a couple questions. We are recording this for our website, so please, as you ask a question, raise your hand. We'll get a microphone to you. It's also a big room, so that'll give everybody a chance to hear your question. But yeah, we're open for questions, and we've got a couple of microphones.
Mark, talk about your investors. What's the minimum amount to get in? What's the largest amount? And what percent are individuals? And by the way, I am aware that you have never sent me a prospectus.
In our case, we are currently investing out of two different funds. We have roughly a $250 million fund and a $450 million fund. And our investors are primarily public and private pension funds, and we have a reasonable number of university endowments, actually. And so we have a $5 million minimum. We have the right to waive that, and we have waived it only in the case of, we have a number of our former management teams. Over the history of the firm, together with CGW, we've done about 60 platform companies, and so many of our prior CEOs and CFOs are investors in the fund, but otherwise it's 100% institutional. And I would say our average investment in our current fund is probably in the $22, $23 million range. And, you know, we're a small group. We've made the decision that it's just easier to administer things when you're dealing with a smaller number of, you know, institutions. You know, that on their side, they're geared up to do this. You know, they're administering, you know, issues every day, writing checks, those kinds of things, whereas with individuals, you know, there's a lot more work involved people are on vacation, you know, it's, because when we call capital, you know, we need the checks within 10 business days, and so administering a large number of individuals is not something we're set up to do. Well, if there's nothing else, I will say thanks very much and appreciate the opportunity to speak.
Okay, thanks, Mark.
Thanks.
Mark, on behalf of our alumni, I want to present you with this glass sculpture by a local artist, Loretta Eby.
Oh.
Thanks very much.
Well, thanks very much.
Okay.
Appreciate that.